So valuation is one of the most basic and fundamental questions in finance. So what is the value of a company? That's a basic question. The standard approach to this question have looked at this question and tried to answer with the so-called present value approach. And basically the idea of this approach is that the value of a company is simply the present discounted values of the future cash flows generated by the firm. So to implement it, we need to forecast the future cash flows of the firm, but we know that the manager will try to invest to the point where the marginal cost equals to the marginal benefit. So by observing how much the firms are actually investing, we can infer what the marginal benefits are. And that's where the approach comes in useful, because its marginal benefits are exactly the future cash flows generated by the investment and discounted at the appropriate discount rate. We believe that there's several implications of our approach. So obviously determining the value of a company is an important question, and this can be useful for many applications. For example, to determine the fair prices on mergers and acquisitions, or in equity issuance and repurchases. We want to know if the mergers are doing at the fair price or not. So by having the fundamental prices, we can evaluate that. We also can apply this framework to understand the value of assets that are not traded. For example, we can value a plant, which is part of the company, so we can value the different plants of the firm. We can value firms that are not traded, so private firms. Because they're not traded, we don't have their market values, but we can infer what the fundamental market values of these firms are. That's how it would work.